That was a crazy week in the markets. We ended up almost another 1% in the NASDAQ today, up about a quarter percent in the S&P, and then the Dow Jones about 0.8% on the back of some rather decent economic news between the PCE and also the finalized consumer sentiment for January and GDP, which we had released yesterday. That's a lot of good things leading up to the FOMC meeting that's coming up next week. So what I want to talk to you about in this video is why are the markets going higher? How high will they go? What will keep them going up? What will cause them to come down? And then finally, what does the Fed rate hike schedule look like from here on out based on the sort of reports that we get? So with that said, I'm Dr. Stock, Doctor of Education. Let's get right into it. Here we're looking at the daily chart for the SPY, which tracks the S&P 500, and this is a rather zoomed out view of it. You can see the downtrend that we've been on, and if we zoom in more to see more recent history, you can see we're up above this orange line, which is the 200-day moving average, and up above the blue line here on the bottom, which is the 50-day moving average. These are both the simple moving averages, and this little golden cross, which is a lagging indicator of a bullish spike. So that convergence that you have between the two, this positive slope that you have here to the 50-day, and then this slower moving, still signaling the longer downtrend for the 200-day, and them crossing each other is a bullish sign. And well, you could see that leading up to that we had a fair amount of bullish activity. Now we did break up above the most recent trend line, and so being up above that is good. So resistance has been broken there. However, we have this horizontal line for the S&P that hasn't been broken yet. So I'm gonna grab a horizontal line any moment now. Dr. Stock, there we go. Horizontal line. We still got this line of resistance right here that for some reason for the S&P is just hard to be broken. This is something that I believe is going to continue to be trouble for us leading up to the FOMC meeting. And based on what they say, that's something that could make or break resistance for us in the S&P. For that, I don't think that it's a matter of waiting for enough pressure against resistance to push it higher. I think that it's going to take some rather large-scale news in order to make that happen. Before I move on from this for the S&P, if we do break resistance there, the next high point that we have is up at 428. So that we can have another 5% to go in the S&P, but we have had quite a run now. So if we do break resistance, we're in pretty good shape for the next 5% or so. That would be assuming that we got some very good news coming out from the Fed. That would be something that would help determine what we see taking place. Also, corporate earnings could be a definite part of that. That could be a boon into pushing the S&P higher, and maybe we get that 5% bump to the SPY here that we're looking for. We could also fail to break resistance, and then we get to fall back. We do have this trend line, but I think a stronger indicator for that could be the 200-day simple moving average, and we'll see as the 50-day builds out here if that's also ends up being an area of support for us as we move forward. Let's move on from there to the NASDAQ, the Invesco QQQ Trust, which tracks the NASDAQ. So for that one, well, this was really incredible. So in yesterday's video, I talked about how we had resistance right across the top, and that we did close up above the 200-day simple moving average. You can see not only that, but we also opened there today right at about the 200-day, and we closed clearly above it. Now we can count fully on that 200-day simple moving average as support. Also, this horizontal line that we here have also as an area of support. So that could be good for us to start the week next week leading up to the FOMC meeting. And that is going to be the next big catalyst that we have, is getting some surprising news, I should say, from the Fed following their meeting on February the 1st. What's not surprising would be a 25 basis point hike. What would be very surprising in a good way would be if the Fed comes out and says that they're going to pause here. That is not at all expected, at least as far as I can tell. That it seems to be a near certainty that we get that 25 basis point hike in February. So that would be Tuesday and Wednesday is the meeting. So Wednesday we would get the announcement of that rate hike. So a pause, no rate hike at all in February would be a definite surprise. The upside, we would see all markets really push higher on that sort of news, but it's highly unexpected. As a matter of fact, almost not at all expected. However, the 25 basis point rate hike is. So that's something that I don't think would have too large of an impact on the markets. And really, I think it's the forward guidance that were offered from the Fed, if anything at all, any indication that we have of what's going to happen moving forward. Is there going to be just this one final one in February? Are they going to shed light on what's going to happen on March? Because as of right now, that still is the most likely thing that happens for us for March. When we take a look at the CME FedWatch tool, and we bring it up for March right now, it still says that there's an 82% chance that we get that 25 basis point rate hike in March as well. And I think that that's going to change for us moving forward. So we do have some decent support taking place. When we look at the cues here, the 200-day simple moving average is going to be good for us. Moving on from there, if we zoom out a little bit from that, so from this area over here where we started stuttering to the top that we have right at about, actually I can put my cursor right on it so we can see what it is. We closed at 309, so that's $13 up. So we could possibly squeak out another 3 or 4% from the NASDAQ before we really start to hit another area where we start to stutter on that. And even the 50-day simple moving average that we have here, right here at 306, that'd be about 3% up from where we sit right now. So that could be very, very positive for us. And people are very hopeful. Honestly, I think some of this euphoria comes out of a possible pause in March, even though that's something that's not very likely as per the Fed Watch tool that I just had on screen. However, as we hear that news come out, if we hear about pause in March, that's going to be excellent for markets. If we hear that the 25 basis point hike is more of a certainty, I think that that could be something that diminishes some of the strength in this most recent bull rally that we see in the markets. Maybe we return back to support, and I don't really know that it would be enough to crush us from where we're at and send us back down to those previous lows. I think that they could stay a decent bottom for us for a good amount of time in the markets, as long as the economic reports that we see coming out still remain favorable. With that said, let's move over to the GDP, which we got out yesterday. I'm not going to spend a lot of time here, but 2.9% is slower than what we got for Q3. However, that's the advanced report. We still have the second estimate that comes out at the end of February. There it is. It actually says it right here on screen. Next release is February 23rd of 2023. So I think all eyes are going to be on that to watch and see just how much that revision includes that sort of cooling. Now, that talks about 2022's price action, which includes October, which was pretty nice for the economy, at least as far as GDP goes, and also November, which wasn't so bad, and then December was quite a slowdown. So I think we see a bit of averaging that takes place in that quarter. Q1 of 2023 is going to be really telling for us that just about what exactly we're facing. It's going to be that confirmatory thing that tells us more about what sort of economic situation we find ourselves in terms of recession. You know, the big R word that everybody keeps on talking about when it comes to the economy. So that's something that we want to keep a watch on. We want to watch for those downward revisions or upward revisions. I don't think that upward is going to be bad for us. As a matter of fact, I think that would be good for us in the markets to see an upward revision on the second estimate on February 23rd. I think that would be green to show us that the economy didn't slow down nearly as much as we thought it did, and a little bit to the downside on that are unchanged. I also don't think it's going to have a huge impact on markets as long as it stays decently positive. I would say above 2.6% for Q4 2022. That said, we'll move on to personal income and outlays for December. So we'll just bring up the table that's right here, and you can see December's results all the way over on the right. So personal income in current dollars. So this would be unadjusted for inflation. So you can see moving into October how rapidly that went, and brings in the idea of possibly a wage price spiral. Not really all that good, and October was not a great month for us. November cooling down, December cooling down further. The fact that we're trending downward from October is really strong for the markets, and I believe it's part of what helped them rally. Disposable income is also something that's cooling off, which means that it's calming down the consumer, and without having such strong consumerism, that also reduced the risk for inflation. As we watch that, moving on to PCE, when we look in terms of real PCE, negative 0.2 and negative 0.3. So that is incredible for the markets. I think that that's a big thing that moved the markets today. When we look at that price, I think as that got digested, that was something that really helped move them along. And then 0.1 and 0.3 for the price for the PCE price indexes. When we look at those are very typical values, and also very well moderated values as far as inflation goes. And then we have their year-over-year numbers of 5 and 4.4 when we exclude food and energy. Now, I do want to move on from there down to this table, because when we look at the table, when we look at the revisions, we actually have significant downward revisions when we look at PCE. Actually, I'll start at the top. When we look at personal income, I get excited and I get ahead of myself. When we look at personal income, current dollars were actually revised downward. And then disposable personal income, so fund money or savings money, was also revised downward for November. And then also personal consumption expenditure revised downward into negative. So that would be the amount spent dropping. So this would be that the consumer would be not so strong, which would be a good thing in terms of calming down inflation, bad thing in terms of slowing down economic growth in terms of GDP. So that's something we want to keep an eye on. Something that I want to bring up from that is from the historical comparisons. When we look at personal income and outlays, so this is a document also found on BEA's website. And right here, this personal saving rate of 3.4, let me zoom out a little bit more so we can see the headings on this. So the last period with a larger value was the fourth month of 2022. So that means April of 2022 was higher. And the last period with smaller value was 2.9, and that was in November. More importantly, when we look at the data on that from St. Louis Fred, let me shrink this up. Well, you can see the trend over time and how all the way through from back at 2013, we're at 5s, 6s, 7s. And so the personal savings rate was fairly high compared to what it is now. And you can see the economic stimulus that took place during the pandemic and while things were shut down. And then the rapid decline that we had in personal savings rate from that time and all the inflation that took place. So that would be very strong consumers, a lot of spending, not a lot of saving. And then let me zoom back out. There we go. You can see this little cup that we have here, just that little tiny curve up. This is something that as we see that continue to curve up, it means that people are saving more money, which means that they're not spending as much money, which could be an indicator of less GDP going to Q1. So we want to keep an eye on that. But that also is something that can indicate that inflation is also going to continue to moderate. We don't want it to push into the point of deflation and cause any sort of deep recession. That would be bad for the markets as well. And if we want the markets to stay green and to really reverse the bearish trend that we've seen and turn into an actual bull market once again instead of just a bull market rally, then this is something that we want to keep an eye on. So I thought that was really good for us. The last thing that I have for you for the economic reports is the final results for January 2023 from the survey of consumers out of the University of Michigan. And when we look at the final results, we have values that are below what January 2022 was prior to Russia's invasion of Ukraine, for example, and all the inflation that we saw. And you can see the low results we had in December. January is increasing. You can see the month-over-month changes are healthy. Year-over-year changes are, like I said, is still a little bit down from what they were. So as we read through some of the information on this, it says that the consumer sentiment remains low from a historical perspective, but continued to lift for the second consecutive month. So that's good. So moving into February, we want to see this consumer sentiment continue to rise. As that rises and inflation expectations come down, that is a good thing for markets. So when we zoom down from there, we can see inflation for the year ahead expected to fall to 3.9, down from 4.4. So we want to continue to see that moderating as well. And then also looking at long run inflation, sticking to 2.9%, which goes along with the Fed's target of 2.9 to 3.1%. So as far as the economic reports go, we are sitting very pretty there. Will the markets keep going up? As long as we keep getting reports that are positive. So we want GDP, we want it to, of course, come out as still growth, just hopefully not too sluggish, and certainly not economic contraction where we would be facing any sort of deep recession. That's something that we want to stay away from. When we look at personal consumption expenditures, so PCE, CPI, personal savings rate, we want to see inflation and those inflation measures continue to moderate. They don't necessarily have to drop, but they do have to remain steady within around that 2 to 3% when at an annualized rate. So those are things that we want to keep in mind. For CPI and PCE, consumer sentiment, we want to continue to see that increase as well, along with a moderation in the inflation expectation, because that could be something that, if too much inflation is expected, that could really impact the consumer spending habits, and that could also be bad for the markets. So what I believe is going to stop the Fed from hiking rates in March, I think we're going to have to see downward revisions in GDP. I don't think stabilized is going to be enough. So when we watch that second estimate come out, if we see that come in lower, that could be honestly good for markets as long as it's not too low. So we want to watch that second revision, and if it comes in, like I said, low but not too low, so around like 2.7, 2.8, possibly down as low as 2.6. I think that the markets could honestly rally off that news. However, that also starts to bring in a question, just about the strength that we have of the economy in Q1 of 2021. Is this downward revision? Does that mean that we're going to face a further recession in 2021? So we'll have to see how the market responds to that. CPI, again, we want to see that come in low, inflation moderating. We don't necessarily need negative numbers there, but we want the low numbers like 0.1%, 0.2%, and that can be either for all items or that could be core CPI. Also, jobless claims, housing data coming in that we see slowdown in the housing market, that prices coming down for those homes. So watching the prices stabilize is part of the Fed's dual mandate. Also, maximum employment is also something that we want to keep an eye on, as that's also part of the Fed's dual mandate. So as long as inflation is moderating, I can see maximum employment being the next thing that they put their eyeballs on, because inflation has had their attention for a long time, and the Fed does not want to have inflation come roaring back up because they did too little too soon. So I think we get the 25 basis points as is planned, pretty expected. I think that as long as February produces a very good convincing argument that inflation is continuing to moderate or possibly even tick down a little bit, GDP revision also ticking down a little bit, I think that those could be convincing arguments, along with consumer sentiment, for the Fed to pause the rate hike during their March meeting and then sit and watch from there. I think that that would be very bullish for markets. I think we would see a lot of green from the markets as soon as February 1st, if that's the indication that we get from the Fed. If the Fed comes out with hawkish rhetoric that makes people feel like there's even more of a certainty with that 25 basis point hike, I think it's going to rain on our parade a little bit and push the markets back down, allowing them to retrace a little bit. However, in light of all the other positive economic news, I don't think that it's something that's going to cause us to revisit previous low levels. Something that might cause some more downward pressure would be the earnings reports that we get out and the guidance coming out of the companies reporting on those earnings. So we want to keep an eye on earnings, pay attention to the guidance that we get for 2023 coming from those companies, and see what they're saying for the economic outlook, and watch the reports as they come out and update accordingly. If you want to support what I do here, please find the links down in the comments. Go ahead and click those, sign up for Moomoo or Webull, and get yourself some free stocks. So that's you paying yourself, and it works out because you support the channel. I also get a kickback from that, and then also the Patreon link there if you would also like to interact with me over at the Patreon. Thank you very much. I'm Dr. Stock, Doctor of Education. See you in the next video.